All right. Good morning, team, and welcome to our December Money Matters Mastermind as we are going to be reviewing our financials for the month of November now that we've closed that out. And we'll also be diving into a conversation about telling your money where to go in 2022. So I will now turn it over to the lovely and talented Miss Julia Cumming to take us through our highlight sheet for the month of November 2021.
Good morning, everyone. All right, so I'm going to go through the numbers that we had for November. We added 8 new agents last month, bringing our total agent count to 448 with a total of 32 appointments. Our contracts written, we wrote 437 contracts, which is up significantly from November of last year. We wrote only 367 last year in the month of November, so that's up 19% for trending upwards, still 6% year to date. And 206 of our agents were contributing to writing those contracts, which is 49%. That's a little bit low. We've seen upwards of like 52, 53%. So that just tells you the concentrated contracts written are by a fewer amount of people. Listings taken also way up this November, which is a great sign. We took 205 listings in November, and last November we took only 176. So that is up 16.5% from last November, also trending upward about 6% year to date. And again, this is actually a little bit low of the concentrated agents who took those. Only 75 agents in our office took a listing, which is 18% of our agent body. And we typically see that around 20-21%. So that is also a little bit low for being up being up 16% in total listings taken. Total GCI, which is the gross commission income that comes into the office, that is up just a 0.5%. So that is really in line with where we were at last November, a little around 22 million. And that is significantly up year to date, about 15%. So that is the commissions that the agents are receiving and bringing into the office has been trending upward all year long. Our company dollar, we collected $263,000 in company dollar for the month of November. That is down 6% from last November, which was around 282, if my memory serves. I didn't write that number down. Which was an insane comp for November. So we were prepared to not hit that based on last year's numbers and got way closer than we expected with 263. So still trending upward about 2% year to date, and hoping to get close, if not exceed, for December's company dollar number as well. As
Gonna be close.
You probably heard Mike say on either team meetings or these meetings before, the fourth quarter last year was the best quarter potentially in all quarters of company history. So we are up against a lot of high comps in a lot of categories. So, looking at those trends and trending upward in the first 3 quarters of the year keeps our year-to-date numbers up as well. Okay, profit share was up last month. So it was 118 in the month of November. That was up about 6.5% from November of last year. And we are trending upward 15% year to date in profit share. So that's, fantastic. Continuing to, even in the midst of different months having lower contracts written and listings taken, our profit continues to exceed last year.
Yeah, I mean, that's really a really positive sign in terms of our partnerships, because company dollar was down, profit share was up. How does that work? Well, it comes through in the next section.
Mm-hmm. Yeah, so our title company, this is the same figure that you saw in October and that you'll also see in December, this $33,500. So That is the total profit that we have from GM Title from their third quarter's closed business. And then we get one check for that and we spread it evenly over the next 3 months. So we are consistent with what we share from them. And there's not any, hills and valleys with how we profit from GM Title. America's Preferred Home Warranty is pretty consistent at 5,200. It was 6,200 last month. That, just depending on closings and when we get those checks, has a little bit of movement, but that's pretty standard in what we've projected for next year. Cross Country Mortgage is $8,500 a month. I don't know who's new to this call. We got an increase with our MSA with Cross Country this year. It used to be 7,500 monthly. So we now receive 8,500 monthly from them. And then our property management company, we profited 19,900 in the month of November. And this is the one I wanted to point out. I took a couple notes on. This is up 100% from last November. We shared 10,000 even last November and 19,992. It is up like 99.9%. And these are just some figures from the first 11 months of 2020. We profited $102,000. And in the first 11 months of 2021, we have profited $160,000, which is up about 57%. So I think that one, GM Title and Cross Country Mortgage are a lot more prevalent in our faces because they're things that we do in all of our deals. But just remembering the property management company and how much of a resource it can be to you, your clients, your investor clients, and all that it's doing for the market center and our profitability is incredible. All right, and I will close it out here. Our total closed units was 408. This is just barely up from last November. We were at 406. And we're still trending upward year to date on that. Our closed volume down a little bit at 86.9 million, which, that down 2.5% or up 0.6% is really small in terms of what the numbers were in the prior year. And still trending upward 16% in closed volume, which isn't a surprise with the pricing of homes still on the rise in a lot of areas. So we're going to see that probably through the end of this year and into next year with the closed sales volume being up. And then we'll probably then see it be down a lot as we're looking at year over year and how high this year's were. And our average sales price, again, is just continuing to be at an all-time high. For the month of November, it was $213, and our year-to-date average is $225. So that's huge. We were, hovering around 200 for a while. So to be at 225 for the office's average sale price is awesome. So that is all I got.
Any questions about any of the numbers or our year-to-date or the path going forward even?
Mike, those appointments, 32 appointments, are those all with agents in production? Co-broke?
No, that would span the it could be somebody who shows up to a career night that's not in classes, somebody who's in classes or completed with classes, or somebody who's an active agent.
We know breakdown, like was there like 2 active agents, 20?
We track it based on there's everybody that's like 7 units of production or less, all the way to like the man on the street who wants to show up to a career night. But I would say we're probably 70 to 75% going to be people in classes or that are completed with classes and new licensees.
Gotcha.
Yeah, last month we had 5 appointments with agents in production that had 8 or more closed units. So that's how they call them R1s and R2s in Keller Williams world. So an R2 is if it's somebody licensed in production with 8 or more closed units. And then an R1 is anyone under that. So they could be licensed and only close 6 houses, or they could not even be in classes, which is just how KW's chosen to track it and separate it. So of the 32, 5 of them had 8 or more transactions in the last 12 months, but it doesn't break out additional ones that are licensed out of the additional 27 appointments.
Yeah, I can tell you, as it'll probably track from a ratio standpoint. If this year we have recruited 100 and, sorry, I just lost it. If we've recruited 138 individuals, we're looking at 93 of those were newly licensed, and then the balance would be licensed at various levels of production.
Okay, thank you.
Yeah, which is a little bit better than our historical average, but not like a huge delta. What other questions do we have?
I can add another point about listings
Yeah.
taken. So December
Sure.
is like typically one of our lowest months, as you could imagine, just with the holidays, less people list their houses. And last December, we only took 143 listings, which is, way less than we did in November of this year, which was 205. Month to date, we are at 85 listings. So we should expect that to be a lower number again this December.
Yeah. All right. Excellent. Well, thank you so much, JC, for the recap. I want to dive into the education portion of today's call for this conversation around telling your money where to go in 2022. And so we're going to dive into a conversation about the path of money so that we have a framework with which to decide how we want to use the money that comes into our lives. So I think that this is a really solid framework that Gary Keller teaches consistently. And I think that it's helpful to identify all the different buckets and what limited number of things we can actually do with money. And once we understand that, then we can start to build ratios and be really intentional about what money comes in and how we actually use it. So this is it's a graphic that could probably stand to get a little bit sexier. But this is the path of money. And so this breaks down how to generate cash flow, what you can do with that money, specifically what it means from an investment standpoint, and then more specifically what it means from an active and passive standpoint. So I'm going to walk through all of this under the framework of you're kicking off a year in just a couple of weeks, 2 weeks to be exact, that is going to be, for a lot of people that I'm looking at on this call, it could be the year that you make more money than you've ever made before in your life. And that level of abundance can create a lot of opportunity. It can also create a lot of opportunity for bad things. Sometimes we see individuals who come into money quickly or suddenly. They are more apt to do things with it that aren't necessarily constructive or long-term, or worse yet, put themselves in a position where they have long-term debt or they're in a bind. So as we look at that, we want to make sure that we're having a conversation about knowing at the beginning of the year what we want to do with our money. In the middle of this chart is really the most important thing in my book. But let's start here on how you make money. Hopefully that this is pretty rudimentary for the group, but there are two ways to make money legally. You can work for your money, right? Which is what we do when we run buyers or take listings or run our business. We're doing the things. We are putting forth the effort to generate cash flow. And then there's the alternative, which is to leverage capital assets, which is your money working for you, This could be owning stocks, owning real estate, investing in short-term loans, a lot of different ways. But whether you're working for the money or you're putting your money to work for you, right? Which could also be by employing other people, spending capital to get work done to generate more money. It's important to know that there's going to be a distribution here for you, for the people who are just getting started, 20, 22, 23 years old. You're probably going to be 99% on the human capital side of things. And a lot of times we talk about this idea of, I want financial freedom. I want to retire. I don't want to have to work, yada, yada, yada. And we see it as a binary thing. Oh, here's all my human capital. Here's all my capital assets. I would challenge you. And then I'm going to move my human capital to 0, my capital assets to 100%. And that's going to be my cash flow. I challenge you to look at your life and how you make your money on a sliding scale. And just where are you right now? How much money are you generating to fund your perfect life through human capital, right? You can increase that or you could decrease that. And same thing with the capital assets. But instead of waiting for some finish line to retire, how can you live the same life, create the same cash flow, do the same things, but dial down the human capital component and increase the capital assets component? So this is a thought called retiring over time. Instead of retiring all at once, you retire over time, just working less and less and less and forcing your money to do more and more and more. So cash flow comes in, right? You get money in your checking account. There are only 4 things that you can do with that money. And I challenge you to find a 5th thing. You can invest it, which we're going to deep dive a little bit. You can save it, which we'll talk about here in a second. You can donate it, which, is a very important thing to do, or you can spend it, which is also a very important thing to do. If you're a capitalist and you believe in the global economy, spending money can be a very good thing for everyone. But let's work those back to front. Spending money is not a bad thing, right? When we get into these conversations, I feel like so often everybody wants to tighten their belt to the last belt hole. They want to tell themselves that they're never going to eat out again, and that they're never going to, they're going to downgrade their vehicle, and they're not going to spend any money, and they're going to save their way, or, through a reduction in expense, they're going to be wealthy. And that very well may be a way to redistribute your capital. But I think it's very important to understand that there's not really a long path, a long track record of people consistently being able to zero base their lifestyles and still be happy and successful and generate the cash flow that they want. Like, it's important that you spend on the things that bring you joy, or that you're spending your money in places that you think are important, taking your spouse out to dinner, maybe it's the car that you drive. Like, there's going to be a lot of people who will have a lot of opinions on things. I think it's okay to engage in conspicuous consumption, but I just think that you gotta really pick a lane there. You can't engage in it in everything. You can't have nice handbags, go out to nice dinners, take big trips, and drive fancy cars and fly first class and spend all the money. So what I want you to think about, and if you're writing along at home, draw up these 4 boxes, and just as a percentage of your cash flow, your expectations for next year, how much do you want to spend? How much do you want to donate? Which you can do. I mean, that it's a way to create money. You donate, and you get a tax write-off, so it's helpful to everybody involved. It's a win-win. How much do you want to save? Now, savings are getting a lot of flack right now because of this thing called inflation. All the money that you have in the bank is worth about 6.5% to 7% less than it was 12 months ago. That being said, I think that and you'll hear people say you shouldn't have any cash on hand. Everything should be debt. Put it all on credit cards. That's one way to look at the world. I definitely see that it makes sense. I also believe that, having a pile of money within arm's reach is never going to be a bad thing in case of emergency. I'm not saying that you need to, you need to save all your money and that, the stock market's the devil and it's going to take everything away from you. What I'm saying is that the idea of having 6 to 12 months on hand, or being able to replace a vehicle with cash and not take on the burden of a payment, like those things are incredibly valuable. So the extent to which you save should be to hit a threshold around your lifestyle and some worst case scenarios. And then finally, the idea of investing, right? And this should be a very prevalent idea in everybody's mind. And we're going to break down some investment opportunities and some things to think about. But if you work it right to left, right? What are the things that you're going to spend on? Who do you want to donate to? How do you protect yourself from a savings standpoint? And then let's have a conversation about getting those from percentages to raw dollar amounts. And then once you have the money that you need to spend, the money you need to donate, the money you need to save, we should get really, really aggressive on the idea of putting the rest of the money into investing. There's only two ways to invest. The two basic investment choices are: you can lend the money out as an asset to somebody else, or you can own something, you can buy something with that money. Different timelines, different life stage and age in life are going to dictate which one you want to do. Ownership of real estate should be something that's on the forefront of all of our minds. Let me go back to this real quick. Your mortgage is not in the spend bucket, it's in the invest bucket, right? Because that is you're investing in an asset there. So ownership of real estate, not only your personal home, but investment properties, is a great way to funnel money into that investment bucket. But you can either lend or own, and you can either do that passively or actively. The passive versions of lending are putting your money in money market accounts, CDs, bonds, T-bills. These are things that typically flow through banks, right? So you're taking your money, you're giving it to the bank, they're giving you a certificate of deposit or a bond, or you're buying a bond from the government, and then you don't do anything until those things mature, right? Very passive way to lend somebody your money and get it back. I think that passive lending component is interesting in the face of inflation as well. Not all of these always hold up in with respect to being really impactful or the right thing to do at the right time, given what's going on in the global economy. But very, very important to know that there is a passive lending option. There's also passive ownership options, right? So I don't mean that I bought this property and I flipped it to the property management company, and now I don't worry about it. We'll talk a little bit about that in a minute. But the passive ownership looks like stocks and REITs and mutual funds and the like. And that is where, when you own a stock, you legitimately own it. You have a share in the company, right? When you own portion of a REIT, you legitimately own a portion of the real estate in that investment trust. It might not look or feel very different than the lending side of passive. However, there is a physical asset backing it up. And so some people feel more comfortable or more confident with their investments when there are physical assets backing them up. Other people would say, hey, I don't see the government going bankrupt anytime soon, so bonds are the way that I like to play. These are all things that you'll want to understand about yourself, your risk tolerance, and what your goals are and what your timeline to your goal is, right? Because passive lending is probably the lowest rate of return. Passive ownership is next. Active lending and active ownership then move in a much more interesting and aggressive pattern However, they do involve more risk. So let's talk about active lending and ownership. Active lending is owner financing or private lending. There aren't there aren't a ton of opportunities for either one of these. There are more for accredited investors, which there are some requirements around becoming an accredited investor. I think it's $1 million in net worth, and that gives you access to some venture funds and some owner financing. Some private lending opportunities. And then the thing that hopefully we all have at the forefront of our brains is this idea of active ownership, whether it be at a business, our real estate business, or two, real estate, whether it be our primary or our investment properties. And so again, moving back to this, when we think about our financial goals for today and into the future, how aggressively do we want to pursue whatever it is that we want to pursue, right? I want an investment portfolio, whether passive, active, lend or own, however you distribute it. I want that to pay for my kids' daycare, my kids' school, my kids' college fund, whatever it is, or my vacation, or I want to start to turn the dial from human capital to capital assets in terms of where my cash flow comes from, such that I want to replace with investment cash flow the having to sell 2 homes each year, right? So I got to get 10 grand in cash flow from capital assets annually, so that is on average 2 less homes. Do that over 10 years, you don't have to sell any more homes anymore. But I think it's important to understand what is the size of the prize at the end, and then how much are you ready to dedicate here after addressing these first 3, right? I believe that the tendency would be like, oh, I'm going to invest first. But if that was the case, you would have invested now, right? And some of you are, I understand. But I like to approach this from the concept of, you're going to spend what you're going to spend. You should probably spend less. You should give to charities or to causes that you care about, and you should save money. You should also know where you're going to invest when the time comes, because a lot of people squirrel away money for investments and then don't actually go looking for those opportunities, or don't actually know how to go about it. Now, we have an investor mastermind. We have lots of investors in our communities. We have lots of investment opportunities as a company and as real estate agents. So I think that it's important to really set an aim as to what that looks like. If you missed yesterday's class with the cross-country mortgage folks around how to secure financing for investments, or if you missed any of our investor masterminds where we covered everything from housing vouchers to Airbnbs, right? Like, the resources, I believe, are there. The opportunities there. I think understanding what it is that you want to do on the front end will allow you to direct those finances in the right direction. One thing I will say about investing in real estate, well, I'll say this about owning the business ownership, which is active ownership first. There's always been this conversation around building a real estate business that you could then sell, right? Selling your book of business. And we've seen it happen a number of times, but there's a really, really interesting trend taking place for inside of our industry right now with the mega teams, right? We're talking billions a year that put together platforms that you can offload your business to for a fixed referral fee on all the deals generated from that database. And so I think that, there's Ben Kenny's Place, there's Livian with Adam Hergenrother, Jose Medina has the Impact platform. The Easy Sales team is developing a platform, and there's probably a half a dozen others throughout the United States just inside of the Keller Williams ecosystem. So when you think about active ownership and investing in your business and building it, I think the idea of selling your business has always been one that's kind of hard to conceptualize. But if you, over the course of years, build a brand that is recognizable, and you have a book of business through a database, your database is your business, that level of investment and that level of success, for lack of a better term, could put you in a position where you could move your business ownership from the active to the passive. And I was in Austin, Texas at a mastermind with Gary Keller just 3 weeks ago. And there was a person with a $75 million business who did just that. And they're making more money not selling real estate because the people who have the platform and have the ability, so to speak, to really squeeze blood from the stone out of people's databases, they're doing 4 times as many deals and making 30% of the money, which they don't do any work and they net more. It's really something interesting. I don't think that it's something that happens tomorrow, but as you look at that, you look at your options, right? You could sell, when you sell your stocks, right? You can sell stocks to buy a piece of real estate. You could sell your real estate business to build up a whole mess of capital to do private lending. Like, all of these things are interchangeable and movable, but it's just knowing where your goals are at. From an investment in real estate standpoint, there's really nowhere that it's easier to do than here and with us. So if you think about the idea that, and especially with you being in the industry, you've got preferred inspectors, you've got preferred contractors, you've got all these great things inside of your ecosystem. Cross Country Mortgage has an entire platform that they use to help people from an investment financing standpoint, and they love us and we love them, and that makes for a really great partnership there. And then we have a property management company with over 1,000 doors under management, and growing, that you're going to get somewhere around 8 to 10% management fee, which is low. And you could identify a property on a listing appointment, buy it, have it financed by Cross Country, have it have the title work done by GM Title, and then have the property managed by Greater Metropolitan Management. And what that allows you to do is to just take capital, and that's where I really think that the real estate ownership can be more passive. If you're not managing it, it's not all your money, and it's still creating a physical asset. So I think that you can blur the lines here by leveraging some of the resources. But at the end of the day, all of those things create financial returns, which then start to bend the map at the top of the page. What we're looking at here is just a loop, right? You work for money, you do something with that money, you get a return. What do you do with that next set of money? When you think about 2022, think about all of the investments that you have right now. Maybe you're part of a title joint venture. Maybe you have an investment property. Maybe you're engaged in profit share. Maybe you're maybe you own some stocks that are throwing off some residual income. Awesome. Then think about all the money that you made as a part of your real estate business, right? The money that you had to work for. And then see what that ratio is, right? Maybe you made $100,000 selling real estate and you made $10,000. Let's say you made $90,000 selling real estate and you made $10,000 off of your capital assets, right? So you had $100,000 to work with last year. As you look ahead to this year and even beyond, what do you want that ratio to be? It's not going to go to 50-50 overnight, but how are you creating more capital assets? How are you putting your money to work for you more? And what do you want that to be? If you can move it from 10% to 15%, right? or if you can move it from, $10,000 to $20,000, there becomes, the snowball effect starts to take place, right? There's a reason that the people with the highest net worth in this country are simply just the oldest, right? The only thing directly correlated with a 99 R2 value for how much wealth you have is how old you are. The longer you live, the more wealth you amass, right? And there's some things that are happening that are limiting that from being true going forward. And it has less to do, I think, with what's going on in the world and more to do with our awareness that we should be trying to find more ways to invest, more ways to generate passive financial returns in the near term, so that we will have them, supporting 100% of our cash flow in the long term. So as it relates to this, this chart, is there anything that you could poke a hole in here, right? Is there anybody see anything else that you could do with money? Anything that you see, like from an active to passive lending and owning standpoint, like what makes the most sense? Or, hey, what about this? Or I am actually invested in that, or, anything? All right, gang. Well, oops. I know it's a it's a little bit of a drier topic. Money typically is, right? That's why boring people always tend to have more of it. The idea that that you have to go in with a plan of where are you going to spend, where are you going to donate, where are you going to save, and where are you going to invest, and the idea that you have to do it. You have to do it now to reap the benefits later. And so if we don't, then we won't, right? Jeremy, did you unmute?
Yeah, I love the idea of retiring over time. This really makes the idea of retiring as a real estate agent much more attainable.
Yeah.
We have agents, you see, I don't want to be the guy 80 years old fumbling with a lockbox, but there's agents that are leveraging heavier and heavier, in their business, and, showing less homes, and, working on referral more heavily. And, maybe you do leverage out and sell your database, but that idea of just that sliding scale, I really find that attractive, and it makes this a little more attainable. The idea of, retiring.
Yeah. How much money do you need every year? Right. And going forward. And, the nice thing is to make more money out of human capital, right? You got to work more. To make more money out of capital assets, you got to have more capital assets, right? And so over time, your capital assets grow, your potential for that to hit the sliding scale grows. It's a huge opportunity. But just, if it takes whatever X dollars a year, can you get, in the next 3 years, can you get to where you got 25 or 30% of that covered by capital assets? Because then you get to make a decision, right? So let's say I've got some investments that are throwing off some great returns. And I can either say, I'm going to work a little bit less, or I can say, I'm going to double down on those returns and try and, move the scale more in a couple of years than move it a little bit this year, right? But I think you're right. It's a great concept to really wrap your head around, because it's not a finish line, right? Retirement isn't a finish line. It's if you approach it gradually, you'll do the right things on a daily basis. All right, guys. Any other questions or remarks for the good of the order as it relates to this? I know it was a quick one today, but a couple percentages, a couple charts for you to make around your passive income, your capital assets and your human capital. Donate, invest, spend, and save. Let me know if you have any questions. and we will go from there.